Aegon is shifting gears these months. We have announced three major steps in our strategy. The first one is that we have announced that we will combine our Dutch activities with ASR to create a national champion, the number 2 insurance group in the Netherlands. We have also announced today that we have found a path to maximize the value of our high net worth business in Hong Kong and Singapore by entering into an internal reinsurance contract, which allows us to free up 600 million of capital. And in addition, we've also announced today that after ample analysis, we have decided to continue to actively manage the variable annuity book in the United States while taking an additional step to mitigate its risk profile. And all of that against the backdrop of very volatile markets, as we all know, in the third quarter. And today we have posted a solid set of results with a strong balance sheet, with all our capital positions above their operating targets, and with good steps that we were able to make in spite of the inflationary headwinds that we're seeing in our expense reduction program.
So, Lard, there's a lot going on, I think, is clearly the message there. Reuters have got you down as a miss on the operating line here, in spite of what you've said about the solid delivery. And I just come back to the question that I was asking about the rate hedges in the United States that have generated the loss. Can you tell us a little bit more about your market exposure and the potential for any further impairments or losses running into 2023?
These losses you're talking about are non-economic, non-cash, and quite frankly, accounting noise. The reason for that is that we indeed have large hedge programs that we are running to keep our capital positions strong, and that is in fact what has happened, because look at them. They are above their operating targets, which is important for our clients to know that their money is safe with us. The reason behind this is that the assets need to be accounted on a fair value, market value basis, while the liabilities are on locked-in rates, basically on book value. So there's an accounting asymmetry there. Now, as the industry moves at the beginning of next year to a new accounting standard, IFRS 17, this accounting noise will go away. And therefore, we believe it is much better to look at the operating result, because that is a better reflection of how our business is doing overall.
OK, fair enough, and we'll take that as your answer, Lard. In terms of that operating business then, we've spoken to Amanda Blank from Aviva yesterday. We've spoken to a couple of the big reinsurers as well. It seems that everyone's getting a little bit more excited about the premium environment and the fact that higher cost of money has taken the tourists out. Is that your experience?
Well, what we're seeing, of course, is that inflationary pressures are real. This means that we are seeing inflationary headwinds, but in spite of that, we are able to do a number of things. First of all, we have an expense reduction program. Inflationary headwinds are, of course, a headwind for that, but we are able, in spite of all that, to make good progress. Secondly, we've taken measures. We've hedged, for instance, the balance sheet in the Netherlands to ensure that the inflationary pressures there are basically immunized. And then finally, we make sure that premium increases where we need to do them to pass on the inflationary pressures, that we make sure that we offer the clients flexibility by allowing them to either adjust the coverage, but then against a slightly higher premium, or we allow them to keep the premium levels as they are, but then we need to adjust the coverage somewhat. And by offering that flexibility, we allow in this inflationary environment our premium rates to be competitive, and to ensure that we navigate our clients well through their choices.